Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what's going on, what people are talking about, give you my financial opinions. And it looks like they kind of worked some sort of debt ceiling deal. So maybe that's good or bad for the markets. I'll go over it here, see what the cliff notes are of it. And again, if you want to follow me, it's at funding_finance. And if you want to join our community, it's finding-value.com. Discount for a discount on the coupon code for a discount if you want to join. So we've got a summary of the debt ceiling here. Let's take a quick look at it. The debt ceiling to be raised for 2 years. It cuts spending by $50 billion. $10 billion of new IRS funding clawed back. No budget caps after 2025. No new tax or government programs. Boost in defense and VA spending. Domestic program spending frozen for 1 year. This deal was agreed to in principle, with still a lot of work to do, according to Speaker McCarthy. Spending cuts are just 0.2% of GDP. Now, what are the ramifications of this? We've had interest rates rocketing higher here in the short term, basically a vertical movement. I'm not 100% sure if that interest rate is attributed to this debt ceiling, but if this is a deal and this is going through, what I would like to see is those rates come back down. If they continue higher, we could have a problem with the bond market. If they turn and head lower, I think precious metals are probably going to take off. That means that the inverted yield curve that we're getting here this past week or two, it's going to uninvert. And that's generally market conditions that are favorable for precious metals to go higher in. So that's kind of what my expectations are, but we have to see that in the actual markets. Coming on down, I thought this was funny. It says, if we could get this commodity super cycle going, that would be great. Looks like they spelled that wrong. They would be great. This is good evidence as any for hot home prices have held up over the last 6 months. It says Open Doors operating in 52 markets as of today. Of those 52, 41 are in disclosure states, or states where home sales data are publicly available. Of those 41, Open Door has double-digit listing margins in 34 of them. Yeah, that's more information, more data for a hot home price market. Here's Liz. She says the S&P 500 energy sector's free cash flow yield continues to soar to multi-decade highs. And that's the S&P 500 energy sector. Again, if you basically put a resistance line through here, that is broken to the upside, signaling that the S&P 500 energy stocks are incredibly cheap. I know a lot of people are worried about a recession, and I think the oil price itself may be mispriced in the market, where everyone's kind of on one side thinking that we're going to have demand destruction, a recession. But what I'll say is demand destruction is incredibly difficult in an inelastic commodity like oil. In the great financial crisis, I mean, you're talking that's 2 million barrels per day demand destruction. The deficits that are projected out in the future of the second half of this year, demand is supposedly going to go above supply by over 2 million barrels. So we need demand destruction or an event like the great financial crisis to basically equal the market out. I don't think that we are going to get that type of crash in the market. That's my opinion. Obviously, I don't know that for a fact, but I don't think it's going to be to that extent. And if we don't have it to that extent, that means that we're going to be running deficits on the second half. Conversely, what if we actually get increasing demand, which is what it looks like we are actually getting? We've had increasing demand in March. I think April, I think the numbers came out and said it was increasing demand as well. if demand's going up and we actually get a 3 million barrel per day deficit, we are going to eat through inventories like no other. So that's what we're going to watch. We're going to watch inventory levels of oil and see where these inventories end up. If we get more, 12 million barrel per day deficits like we did, or I should say drawdowns in inventory like we did this past week, we're going to eat through inventories very quickly. And with the free cash flow yield of the energy companies where it's at, I think it stacks up to be a pretty good spot to be looking at potential investments right now for energy companies. So that's interesting there. This is uranium future pricing. This looks absolutely fantastic, guys, in terms of a charting perspective. A lot of the times how this falls and comes back down is the way it comes back up. And this portion there could be something on the lines of that. Maybe we could break out and get a big move, much like John is showing here. What I like is when you look at the candlestick movements on the right-hand side from 2018 onward, you have larger up movements, smaller pullbacks in terms of the size of the candlesticks. That is the characteristic I look for a stair-stepping pattern for a movement on up. So it's got that characteristic that it wants to go higher. And again, if the uranium price, commodity itself, starts moving on up, especially at a rate, there we go, at a rate faster than the consumer price index, that's going to give you good tailwinds behind the equities. And the equities are incredibly cheap in relationship to the physical commodity of uranium. So we could see a big breakout in the commodity itself. Generally, what comes behind it are the equities. Hopefully that's the case, but uranium looks incredibly good from a commodity standpoint. Obviously, I go over the 4 phases of the real estate cycle and all that. I'm going to skip that since I already did a video on that. Here's one. It says, limited industrial artificial intelligence is already being used and people are being laid off. It's been here for years in stealth mode disguised as machine learning and automation tools. One person can fact check the tool doing 100 people's work. Societal and labor market upheaval is already here. I think AI can displace some jobs, but I think there's a lot of jobs out there that if you're doing a hand-built manufacturing procedure, not like just sticking it in a machine, but if you're actually building something and manipulating by hand, I don't think AI is going to replace that anytime soon. A lot of designs that are being produced from years ago are going to have to be put together by humans. AI would be good if the designs are built for automation, where a hole is going to be in the same location every single time. And a lot of the stuff that I've been involved with that actually builds things, I don't think AI can replace it for. It's gonna take a long time because you're gonna have to maneuver locations of drilled holes and all sorts of stuff. And a machine can't do that. It's not at that level. Now, AI, if it gets to a level where it can almost think for itself, I mean, maybe we'll have to see. This is what a bear markets do. They're designed to fool you, confuse you, make you do things you don't want to do, chase things at the wrong time, and probably sell them at the wrong time. And that is true. I have a suspicion that technology sector, depending on where interest rates go and depending what they do with the housing market, if they let the housing market go where we get an inflationary push, which, I mean, in the short term, it doesn't look like Powell's going to let that happen. He's going to hold interest rates higher for longer. At least that's his saying, even though he said that he was not going to raise rates till 2024, which that was obviously a 180 to what he did. But people are going to chase wherever the price goes up. They don't have a strategy, a lick of strategy behind them. They just chase pricing. They're probably going over and running into NVIDIA right now, which has moved on up. We could be in a bull trap for technology sector. A lot of the times when you overlay the expansionary phase of real estate, the technology sector, due to increasing interest rates and high inflation, goes into a bear market. That bear market is seen where the price goes sideways for a decade plus, and you get these large up and down movements in a sideways pattern, which is a large consolidation pattern. That is what I think will happen with technology stocks and stocks in the regular, we'll call it the regular S&P 500. And at that same time, we're going through a bear trap in commodities. And eventually, when commodity prices go up, you're going to see it in the consumer price index. Things are going to kind of unravel in the stock markets because those companies over in the NASDAQ and in the S&P 500, they just consume commodities. That's all they do. And when commodity prices go up, their margins go down, and they're going to have to figure out ways to not just raise prices, because under that condition, money flows and rotates towards things that people need and away from things that people want. And if you're selling things that people want, you can't just raise prices and have the market absorb it, because people are going to start getting squeezed. And when they get squeezed, similar to what we're going through today, money rotates away from certain stocks and sectors, and that's the whole market rotation of money. Here is the market is now pricing in June a Fed rate hike with a 58% probability of a move to 5.25 to 5.5 for the Fed funds rate. We've got Chinese demand, this is oil demand, increased by 1.6 million barrels per day in March to 16.8 million barrels per day. So it increased 1.6 million barrels in March. That is a huge increase. Here's 2023. You can see we are outside of the normal kind of range of 2018 to 2022. We are out on top of that. If we get a little bit higher demand in America, we're going to see all-time highs in demand, guys. And we're pulling back on supply. OPEC is, and even America may, I don't know if we can pump more or not. We'll find out. And we can see a large fiscal tightness in the markets. And if we see this large fiscal tightness and we see inventories drawn down by, 5 to 12 million barrels a week, that those are huge drawdowns. It will have an impact on price at some point. Here's the interest payments on the U.S. public debt is closing in on 1 trillion mark. That's just the interest payment. At this rate, it is soon set to be the largest expense for the U.S. government. Federal government current expenditures, look at this thing go vertical, guys. And they're going to continue to raise rates. This is going to get real interesting with our interest payments. I've talked about it before, where the Federal Reserve is backed into the corner. And maybe it's not the Federal Reserve that's backed into the corner. Maybe it's the federal government. They're backed in a corner. And with this increasing interest rate environment, we're just blowing up the interest payments on our debt. And it's going to be inflationary to some extent, I think. So here's another thing. When money's created, it depends where that money goes. If the money isn't lended, or the credit's not put into the system, you don't get inflation if that money's created and just put into bonds or just put into financial assets. It's not circulating through the system. You get inflation when the price of commodities, the price of energy, and the base input costs go up, and your housing and shelter costs go up. I think everything is aligned for the shelter costs to remain high and the commodity prices on the supply side to go up. And I don't know how effective raising interest rates are going to be to stop that move. But it's also going to put pressure on the interest payments, which they're probably just going to release more bonds, hurting the interest rate even further to go up. More bond releases means higher interest rates if they don't have buyers for it. So I do think that they're going to probably manufacture a recession or scare where people get scared into bonds, creating the demand for those bonds that they are going to have to create and need if they're going to continue to release more and more bonds to the market. It says your regular reminder to not make extra payments on a sub 4% mortgage. And what that means is that your mortgage is being inflated away with the inflation above 4%. And if you've got a sub 4% mortgage, you're paying back less, less purchasing power cash to whoever lended you the money. And that's actually what I'm doing. I am paying it back at the normal rate, not trying to pay it off faster. And I'm paying them back with money that can purchase less in the future, which means I took a bunch of money and I'm paying it back with money that is less valuable, a lot less valuable. It says one of the biggest secrets of wealth building is doing things right the first time. I married my wife 15 years ago. I bought the car I drive 14 years ago. I bought my first house 13 years ago. Switching costs will kill wealth building. And actually, guys, that is very similar to myself. Obviously, I'm not switching wives, but I've dated my wife since 2005, maybe. I think it was 05 or 06. I bought a car in 2005, and I continue to drive that car still. And the house I'm in right now, I bought 2018 or 17, 18, whatever it is. And I haven't been moving around anything. I don't buy and sell cars. It's cheap. It's older. Registration costs are cheap. I've got liability insurance on the car. That's it. Super cheap insurance. Everything I have is basically well thought out, and I don't trade or move things. I fix it when things break, and the parts costs in that car are just absolutely ridiculously cheap. And that's how I'm building my wealth. I just don't spend money. I keep all the money in my pocket. I fix my own car. I fix things around the house. And I don't transact where the transaction costs are expensive. I don't pay interest on anything outside of my mortgage, but that's so low, it's inflation's eating it away. That's how I'm doing it. So some more paradigm shifts events unfolding before the ever sleeping crowd, an almost 50-year rising trend close to breaking down. Guys, man, this is the gold bull era as it came down. Again, this is your bond to gold price in dollars chart. Another big move here. If we can break this gigantic uptrend line of almost 50 years, we could see a massive bull market in gold. I think with the debt ceiling potentially being resolved, we could see interest rates pull back some. And that's going to be fuel for gold, silver, and the precious metals arena to take off. But what I'm really interested in is to see gold start to break away from the interest rate correlation, where it doesn't matter if rates continue higher, that gold starts to take off and people worry about the currency's value. So that's another thing. We need to see that DXY turn and head lower and get weaker against other currencies. I think that will eventually happen. But in the short term, especially, I'm trying to correct that, guys, especially with short-term fears in the market, recessionary fears, that could be all right for gold if we can get the interest rate to fall back down. Here's copper, and I know copper's been heading lower. It's been rough for copper recently, but this billionaire, Friedland, says copper market weakness is temporary. And what he's doing, he's just looking at the supply, demand, and inventory levels. I agree with him. It's temporary, and we will see copper go higher. It has to go higher if we want to do this renewable thing. You can obviously disagree and say, hey, we're not going to do the renewables. It's going to be a huge disappointment. It's not going to work out, and that we're actually going to go back to oil and natural gas and fossil fuels, much like Germany has gone back to coal. That is a possibility, guys. And if plan A, which is their green future, doesn't work out, you better be looking at fossil fuels, because they're going to go right at fossil fuels and try to increase the supply of those fossil fuels. And remember the tech bust too. This is noteworthy. The only other time when the tech sector surged over 4%, while overall stocks declined, were at the onset and the middle of a tech bust, April 2000 and March 2001. So his 2 cents is watch for times when the generals lead, but the soldiers don't follow. So beware of times when the tech stocks surge, but the overall stock markets fall. Is this the double top that we've been looking for, which eventually will fall down in a tech bust scenario? That's that bull trap that I'm talking about. This was a bull trap. It came down, came back up, bull trap, and then it ate it. Came back down, bull trap, puts in a double top, and then we head back lower. The commodity market, I think, is putting in a bear trap at the same time. So they're simultaneously going through this cycle, and we're at different stages in the cycle depending on your asset. So that's his opinion there, and I agree with that. So that's what I've got for today, guys. Hopefully you guys are enjoying your weekend. I know it's Memorial Weekend, so get out there, get some sun, get some vitamin D, have some fun this weekend. I know I am. And that's all I've got. So thumb up for the content, subscribe to the channel. If you want, subscribe to the website. Love to have you part of the community. And we'll catch you guys later. This is Finding Value.